Okay, let's unpack this. Because a surprising turn of events has unfolded. Despite the electric vehicle revolution humming along, Tesla's revenue from selling cars actually dropped.
Yeah, a significant drop, 20% in Q1 2025 compared to last year.
Exactly. It really makes you stop and think about what's happening beneath the surface.
hmm What's fascinating here is that this isn't a straightforward story. It signals a more complex interplay of factors affecting Tesla right now, which goes beyond just overall demand for EVs.
Right. And that's precisely what we're diving deep into for you today. We've examined a comprehensive research analysis of Tesla, focusing specifically on their first quarter 2025 earnings, reported April 22nd, 2025.
And our mission really is to pull out the crucial insights for you.
Yeah, the fundamentals, management stuff, financial health, market vibes, potential pitfalls, all of it. But present it clearly without overwhelming you.
And if we connect this to the bigger picture, understanding Tesla's current earnings and performance gives you a valuable lens into the broader shifts within the automotive and energy sectors, too.
Totally. The sources we've analyzed include a detailed research report using value investing principles, which is interesting, plus various news articles, financial data, all surrounding these latest results.
So you're getting a solid mix of perspectives.
So get ready to go beyond the headlines. This deep dive will give you a shortcut to understanding what's really going on with Tesla right now. Might be some surprising facts, definitely some clear explanations.
Okay.
Let's start by getting a solid understanding of Tesla's business itself. It's more than just making cars, right?
Oh, absolutely. What's interesting here is their vertically integrated approach. They handle everything from the initial design and engineering.
And through to manufacturing.
Yeah, manufacturing, direct sales, even servicing their EVs. And then there's the whole energy generation and storage side, which is growing fast.
That high level of control. It offers potential advantages, speed, data, maybe. But also concentrates risk, I suppose.
That's the trade-off, basically.
Okay, so how did these different parts perform financially in Q1 2025? Let's break down those revenue streams. Automotive sales, still the biggest piece.
Still the biggest, yeah. $13.967 billion.
But, like we said at the start, that's a 20% drop from Q1 last year. And for the whole of 2024, automotive revenue was $77.1 billion.
Which was also down about 6% year over year.
So it really seems that relentless growth in car sales has hit a bump in the road.
The research we looked at emphasizes that this decline is directly linked to lower delivery volumes. It's a key signal, The growth trajectory isn't what it was, it's facing headwinds.
But here's where things get really interesting. Their energy generation and storage division.
Yeah, part's booming.
Seriously. Revenue hit $2.73 billion. That's up a whopping 67% compared to the same time last year.
And record deployments, too. 10.4 gigawatt of energy storage.
Up 154% year over year. Just incredible growth there. And for the full year 2024, that segment also grew 67%, hitting $10.1 billion.
So it sounds like this part of the business is really charging ahead, so to speak.
Nice one. But seriously, it's increasing importance and, crucially, improving margins in energy could potentially act as a buffer, right?
Yeah.
Against the automotive pressures.
Absolutely. The report highlights that. The increasing significance, the better profitability of the energy business. It could indeed become a really crucial element in their overall financial picture moving forward.
Okay, then we have services and other. What's in that bucket?
That's things like vehicle maintenance, insurance, merchandise, software upgrades, the FSD stuff.
Right, full self-driving. We'll call it FSD.
Yep.
And supercharger revenue, too.
Yep, that's in there. That segment brought in $2.6 billion in Q1.
Which was a 15% year-over-year increase. Seems like a pretty steady climb.
This category shows Tesla's ability to make money from its existing customers and infrastructure beyond just the initial car sale.
The recurring revenue potential from software and insurance. That seems particularly noteworthy.
Definitely is.
Finally, regulatory credits. Can't ignore those. $595 million in Q1.
Still a significant number.
Yeah, and for anyone less familiar, these are basically credits Tesla gets for selling zero-emission cars, which they can sell to other automakers falling short on emissions targets.
The report we looked at really emphasizes how critical these credits were for Q1 profitability.
Suggesting that without them, their operating profit might have been, considerably lower.
Potentially, yeah. And for full year 2023, these credits were substantial $1.8 billion.
So given these credits will eventually phase out, what are the long-term implications? Are they working to be profitable without this support?
That's a crucial question. Their long-term viability is uncertain. The research suggests Tesla needs to keep focusing on cutting production costs and boosting profitability in their core automotive and energy businesses. That's key for sustainable growth.
Okay, so that's the money coming in. What exactly are they selling right now, as of April 2025?
Well, the current EV lineup includes the Model S, the updated Model 3, the Highland version.
Model X, Model Y, getting a Juniper refresh rollout.
Right. Plus the Cybertruck, still ramping up production, and the lower volume semi-truck.
Like the future pipeline. That generates a lot of buzz, doesn't it?
Always. You've got the potential return of the Roadster, maybe 2025, the speculated Cybercab, perhaps 2026.
The Robovan, no timeline on that one yet, and crucially, those more affordable models.
Often called Model 2Q or Project Redwood. Production still planned for the first half of 2025, they say?
That lower price point, maybe under $30,000, that feels key for broader adoption, right?
Absolutely critical. The successful launch and scaling of these affordable models is huge. If they face more delays or don't hit the price point or volume,
It could really hinder their ability to compete, couldn't it, with everyone else jumping into the EV space?
exactly. It's a major determinant of their future market share and growth in this increasingly competitive landscape.
And beyond vehicles, they've got Powerwall and Megapack for storage.
Solar panels, solar roof for generation.
The supercharger network that's transitioning to the NACS standard and opening up to others.
Plus software and services, Autopilot, their ADS systems.
FSD supervised with that big goal of full autonomy via over-the-air updates.
OTA updates, yeah. And Tesla insurance in some markets. It's a really sprawling, interconnected ecosystem they've built.
What's interesting is how they position themselves not just as a car company, but as this like vertically integrated, sustainable energy and tech company.
That diversification could be a significant strength long term. This integrated approach, vehicles, energy, software, sets them apart. Could provide resilience, multiple growth avenues as the market evolves.
Okay, let's talk market position. Still dominant, but feeling challenged, yeah.
More than ever before. They delivered 1.81 million vehicles globally in 2024.
But BYD is closing in fast. 1.77 million fully electric in the same year. And BYD actually surpassed Tesla in total EV sales if you count their plug-in hybrids.
Right. And in Q1 2025, Tesla actually lost the top spot in global fully electric sales. 336,681 deliveries for Tesla.
That's a significant shift.
Indeed. The research highlights that while Tesla still has strong U.S. market share, maybe 55% in 2024, even that is eroding gradually.
And facing big competition and headwinds in China and Europe, too.
Considerable challenges there, yeah.
Operationally, they have that impressive global footprint. Fremont, Austin now HQ.
Sparks, Shanghai, Brandenburg, plus the new Shanghai megafactory for energy storage.
They definitely have scale. But the report also touches on challenges with their direct-to-consumer service model as the fleet grows, right?
Yeah, that's a different challenge compared to traditional dealerships. Scaling service and support effectively can become a bottleneck.
Maintaining customer satisfaction, efficient service at that scale, crucial for brand loyalty.
That's a key point, absolutely.
So to wrap up this first chapter on understanding the business, what's the key takeaway for you, the listener?
I'd say the key takeaway is that Tesla's revenue streams are evolving. Energy is growing significantly, offsetting some automotive decline. But the competitive landscape is intensifying rapidly. Their dominance is under serious pressure.
Okay, let's move into chapter 2, management evaluation. And look, when you talk Tesla management, it's almost impossible not to center it around Elon Musk.
His leadership is so intrinsically linked to the company, isn't it?
Totally. And it's interesting how his personal brand and leadership are just so intertwined with Tesla's perception and performance. It's that double-edged sword the report mentions.
Absolutely. On one hand, you have the undeniable successes, EV leadership, innovation, scaling, massive shareholder returns early on.
Right.
But on the other hand, the challenges. Missed timelines, FSD, robotaxi, Cybertruck, those affordable models.
Yeah, the list goes on.
Plus, we're seeing weakening operational performance recently, delivery decline, margin erosion. The report highlights this duality, and Musk's vision was instrumental, no doubt, but the ambitious pronouncements and missed deadlines create uncertainty.
So when the company faces a crisis, how do they typically respond under his leadership?
Tends to be quite reactive, often heavily influenced by Musk's own social media activity. Think Autopilot FSD safety concerns. They release data logs, comparative stats, often while facing regulatory scrutiny.
Mm-hmm.
We saw a similar pattern with the Q1 25 results, attributing delivery declines to factory shutdowns, macro factors, while simultaneously hyping future stuff like FSD progress and the robo-taxi launch.
And the report mentioned they use AI to monitor social media sentiment during these times.
Yeah, an interesting insight into managing public perception.
Communication transparency always feels a bit nuanced with Tesla.
Mm-hmm.
Internally, maybe open. Externally, you have official channels versus Musk's X profile.
And they don't always seem perfectly aligned.
Right. The funding-secured tweet still lingers.
Yeah.
SEC issues from that. And more recently, not giving specific 2025 delivery guidance raises concerns about clarity, predictability.
This reliance on the CEO's personal channel over structured corporate communication does introduce risk, potential for conflicts, inconsistencies. It's a valid worry for investors.
Clear, consistent communication is crucial.
Right.
Right. And the current approach has challenges.
Definitely.
And then there's the ethical reputation, increasingly tied to Musk's controversies, his style, social media, politics, even recent allegations. It casts a shadow.
And the report doesn't shy away from board governance concerns either. Lack of independence friendships, financial ties.
The Delaware court ruling on the pay package, the director pay lawsuit settlement.
It paints a picture of a board that some argue isn't providing robust, independent oversight. The report is quite critical, highlighting connections that could compromise judgment.
These governance weaknesses are underscored by those court findings and settlements.
Strong governance is essential long-term. These are significant concerns investors are likely watching closely.
Okay, shifting to capital allocation, where are they putting their money?
Historically, heavily reinvesting in the core business for growth. Huge R&D in EV tech, batteries, software, AI, like the Dojo project.
And CapEx for gigafactories,
Oh.
AI compute.
Yeah.
Massive spending, right? Expected over $11 billion annually.
Yes, though Q1 2025 actually saw a notable decrease in CapEx, down to $1.49 billion versus $2.77 billion year over year.
Why the drop?
Reports suggest maybe factory upgrades are maturing or a strategic shift to prioritize AI investments, or perhaps just being more cautious given market conditions.
What about M&A, buybacks, dividends?
Mostly organic growth. Solar City acquisition was notable, controversial, Maxwell Technologies too, but nothing major recently, no significant buybacks.
The dividends?
Never paid one, no plans to. They retain earnings for growth.
Now, a key metric for value investors, return on invested capital, ROIC. How's Tesla doing there? Tells us how well they use invested money to make profit.
Historically, quite impressive. Peaks around 20-30% in 2020-23. Very effective capital deployment, though.
But recently,
The report points out a pretty sharp decline. Trailing 12 months ROIC as of early 2025 down to somewhere between 5.8% and 9.3%.
and that's concerning because their cost of capital, their WACC, is estimated higher, like over 15%.
Exactly. If ROIC is consistently below WACC, it suggests investments aren't generating enough return to cover the cost of capital. That's generally seen as a red flag for value creation.
So, wrapping up management and capital allocation, the key takeaway.
Musk's leadership is complex, transformative history, but now a mix of potential and risk. Persistent governance concerns, especially board independence, plus that declining ROIC, they raise real questions about current capital allocation effectiveness and alignment with all shareholders.
Okay, let's shift to Chapter 3, financial health. The numbers. Valuation multiples first, still exceptionally high, aren't they?
Extremely high. PE ratio around 116, 121, forward PE 84, 113, price to book around 11.8. Way above auto peers.
Market cap still huge, even off its peak. Feels like a lot of future potential is baked into that price. The PE tells you how much investors pay per dollar of earnings.
Absolutely. These high metrics show the market still holds very optimistic expectations for future growth and profit, despite the recent slowdown we've discussed. Heavy reliance on the future tech dominance narrative.
And speaking of growth, revenue growth has really slowed. Q1 25 saw that 9% decrease year over year. Full year 2024, only up 1%.
A dramatic slowdown from previous hypergrowth. That deceleration is critical. For a company with such a high valuation, you expect strong, consistent growth. Lack of it puts pressure on the stock.
Investors in high-growth stocks prioritize that. This slowdown could lead to a reassessment, couldn't it?
Exactly. Reassessment of the growth trajectory and the current valuation.
And we're seeing the impact on profitability, too. Gross margin, TPM around 17.9%, but Q1 dropped to 16.3%.
Operating margin, TTM 7.2%, plummeted to just 2.1% in Q1.
Net margin followed a similar path. Pretty significant declines.
This margin compression is a major concern. Indicates maybe their pricing power is weakening due to competition. Higher costs, lower efficiency.
That 2.1% operating margin in Q1 is striking. Why that compression? Pricing pressure, costs, mix of things. What's its signal for future profitability?
Likely a combination. More competitive pricing needed, maybe rising costs for materials, logistics, possibly impact from ramping up newer, lower-margin vehicles like Cybertruck initially. It raises questions about long-term pricing power and ability to maintain high profits as the EV market matures.
But on a positive note, the balance sheet still looks strong.
Very strong. Around $37 billion in cash. Very low debt-to-equity ratio, about 0.08. Solid financial foundation.
That's a significant asset, gives them flexibility to keep investing, weather uncertainty.
Absolutely. Strong cash, low debt, provide a big buffer, allow them to pursue long-term goals.
But even cash flow generation weakened a bit. TTM free cash flow around $3.6 billion, but Q1 was $664 million.
Still positive, but reflects the lower profitability and continued high capex. Maintaining strong cash flow while investing heavily, that's the crucial balancing act.
Consistent free cash flow is vital, right?
Yeah.
Shows the underlying health. So, stepping back, looking at overall financial health now. Main conclusion.
While the balance sheet is very strong, lots of cash, low debt profitability has weakened considerably recently. The volatility and sharp earnings declines are a key concern investors will be watching closely.
We've covered a lot. Business model, management, financial health, all based on Q1 25 earnings and research. When we come back, market sentiment, ownership, risks, opportunities. Stay with us.
Welcome back to our deep dive into Tesla's Q1 2025 earnings. Second half now, starting with Chapter 4, Market Sentiment. This stock, it often feels as much about narrative and enthusiasm as hard data, doesn't it?
What's fascinating is just how polarized the perception of Tesla is.
Yeah.
Very strong opinions. And overall sentiment definitely got more cautious late 2024, early 2025.
Absolutely. Seems like the Q1 delivery miss, tariff uncertainty, competition, especially BYD, and those ongoing Musk governance concerns all fed into that more tempered mood.
But what's also striking is the volatility, that big after-hours rally, even after weak Q1 earnings. It's like the long-term story, future tech potential, can still overshadow current realities for many.
That after-hours rally really highlights the narrative-driven nature. Disappointing results, but the market quickly latches onto future promises, FSD, robotaxi.
Precisely. Underscores how important that future growth narrative is to the current valuation.
Definitely.
Let's talk analysts. What did their targets and ratings look like after the Q1 results? I remember seeing downward revisions before the announcement.
That's right. Sentiment was trending cautious beforehand. Afterwards, it's been somewhat mixed. Some big firms, Wedbush, Piper Sandler, Morgan Stanley, kept positive ratings.
But focusing on future catalysts. Musk re-engagement, FSD progress.
Often, yes. While underlying concerns about 2025 volume, margins, tariffs, competition persist across the analyst community, and we've seen a really widespread in price targets, huge dispersion.
Highlights the uncertainty surrounding future value and performance.
Absolutely.
And the news flow. It's a constant stream, positive and negative. Q1 delivery miss, big negative headline.
The U.S. tariffs created a lot of uncertainty.
Leadership governance concerns keep resurfacing. But then you also get positive news. FSD progress in China, maybe. The robo-taxi launch plan for June 25. Affordable models still planned for H1 25.
And the Q1 report itself generated tons of coverage, weak results overshadowed by that after-hours rally. It's a lot for investors to process.
It really is. The intense, often conflicting news cycle contributes to that high volatility. Each big item can sway sentiment.
Very accurate assessment. Constant influx of news drives volatility and the wide range of opinions.
What about short sellers in the options market? They always have strong opinions.
Tesla's still one of the most heavily shorted stocks globally. Lots of investors betting the price will decline. Short interest actually increased early 2025.
And shorts have seen big paper gains this year.
Reportedly, yes. And high options activity suggests lots of speculative interest, too. People using options to bet on big price swings, up or down.
So, considering all this, the key takeaway on current market sentiment.
I'd say it's characterized by high volatility, leaning cautious near term, despite some optimism focused on future tech. The significant short interest really underscores this skepticism about the current valuation and near-term financial prospects.
Okay, moving to Chapter 5. Ownership structure. Who mainly holds Tesla stock?
It's a notable blend. Institutions hold a big chunk, maybe 47% to 49%, but that's maybe slightly lower than some other mega cap tech firms.
And the major institutional players.
The big index fund managers usually top the list: Vanguard, BlackRock, State Street. A lot of the institutional ownership seems passive, tied to index funds.
Fidelity increased its stake recently, I heard.
Reports suggest that, yes.
What about insiders, especially Musk?
Musk is still the largest individual shareholder, around 13%. Other insiders hold comparatively small stakes.
Kimball Musk sold some shares recently, March 2025.
Reports indicated that insider transactions are always something investors watch for potential signals.
The report mentioned ownership is relatively concentrated. Can you elaborate?
Yeah, Musk's 13% gives him significant voting power and influence. The top 10 institutions hold over 25% combined. But what's also really noteworthy is the huge base of retail investors, maybe 43% of the total.
That large retail base likely adds to volatility and maybe less focus on traditional governance.
Probably contributes to both, yes, compared to companies dominated by institutions.
And how does this ownership structure impact governance? We touched on board independence concerns.
It definitely plays a role. Musk's large stake likely makes establishing a truly independent board more challenging. Retail investors, while showing belief, might not push for governance reforms like big institutions might.
We see shareholder proposals at meetings director terms, ESG reporting, but the board often recommends voting against them.
That's often the case, and the recent proposal to reincorporate from Delaware to Texas has potential governance implications too. Plus, those settlements over director compensation highlight ongoing challenges. It's a complex, often debated governance dynamic.
The concentrated ownership, CEO's stake, large retail base, creates a unique environment.
Different from many other large public companies, yes.
So key takeaway on ownership structure.
Ownership is relatively concentrated. Musk's significant stake, large index funds dominate institutional holdings, plus a very large retail base. This mix contributes to a complex governance environment, a key concern for many, especially regarding board independence and Musk's influence.
Right, let's get into our final substantive chapter, Chapter 6, Risk Assessment. The report had a SWOT analysis: strengths, weaknesses, opportunities, threats. Quick overview.
Sure. Strengths: dominant EV brand, tech innovation track record, FSD AI potential, supercharger network, manufacturing scale, strong balance sheet, growing energy business.
Weaknesses:
Key person dependency on Musk, governance concerns, margin pressure, slowing growth, aging core products facing competition, execution risk on future projects, very high valuation.
Okay, opportunities:
Autonomous driving, energy storage market expansion, mass market EVs, AI and robotics ventures, trucking electrification, charging revenue, international expansion.
and threats.
Intensifying competition, macroeconomic slowdown risk, regulatory changes, EV incentive rollbacks, FSD scrutiny, also trade war tariffs, especially US-China, supply chain vulnerabilities, potential brand damage, tech failures or delays. It's a comprehensive snapshot.
And the report specifically looked at the impact of those 2025 U.S. tariffs. What's key there?
The 25% tariff on imported vehicle parts poses a notable risk. Even though Tesla builds cars mainly in the U.S., they still use imported components. Report estimates this could raise per-vehicle costs.
And the impact is even bigger on the energy storage business because of batteries from China.
Yes, relies more heavily on LFP cells from China. So these tariffs present a tough choice: absorb the costs, hurting margins more, or pass them to consumers, potentially hurting demand.
Some think Tesla's U.S. manufacturing gives them a relative advantage over importers short term.
Possibly. But the overall uncertainty from tariffs, especially the energy segment impact, are significant concerns, likely contributed to recent negative sentiment.
Okay, concluding risk assessment, the overarching takeaway.
Tesla's navigating a complex landscape, lots of internal and external risks. Those U.S. tariffs are a particularly acute threat to the energy business and overall costs. The SWOT analysis gives you a good framework for understanding the challenges and opportunities in this evolving competitive market.
And that brings us to Chapter 7, brief conclusion and the end hook reveal. After this deep dive into Q1 25 earnings and the broader context, overall thoughts.
My assessment: Tesla is at a critical juncture. Undeniable strengths, innovation history, but facing major challenges in a maturing EV market. Their competitive moat seems to be narrowing.
Governance issues persist, financial performance deteriorated, especially profitability despite the strong balance sheet.
Right. And the high valuation doesn't seem fully aligned with current fundamentals. Relies heavily on executing ambitious future plans, plus significant risks. Competition, tariffs.
So for you, the listener, who wanted knowledge without overwhelm, I hope this deep dive gave you a structured, insightful understanding of Tesla's current situation based on detailed analysis.
Which leads to a final thought for you to consider. Given the rising EV competition and Tesla's reliance on future tech breakthroughs for its valuation, what do you think will define its long-term success or failure over the next decade? AI advancements, maintaining EV market share, something else entirely.
And now for that end hook reveal we promised. The value investing perspective and the primary research report we used. Well, it takes a rather cautious stance on Tesla right now.
Uh-huh. The report highlights concerns about that narrowing competitive moat, the ongoing management and governance issues we discussed, and the very high valuation.
Suggesting these factors warrant further individual research and careful consideration before making any investment decisions. Just something to keep in mind.
Absolutely.
Thank you for joining us for this deep dive into Tesla's first quarter 2025 earnings and related analysis. We really hope we provided a clear and insightful overview.
Yeah, I hope it was useful.
If you found this valuable and want more in-depth breakdowns, be sure to subscribe to the Stock Analytics AI YouTube channel. You can find links to some sources we mentioned in the description. And finally, a quick but important reminder. Please remember, this discussion is for informational purposes only, not financial advice.
Definitely not financial advice.
Artificial intelligence was used in analyzing the source material to help spot key trends and insights. But it is absolutely essential that you conduct your own thorough, independent research before making any investment decisions.
Do your own homework. Thanks for listening.